Let me spend a few minutes on financial ratios. Our source of data are income statement and balance sheet. Here we have revenue and costs. Here we have assets, current asset and fixed assets. And here we have liabilities, current liabilities, long-term liabilities, and also stockholder equities. These are our source of data to compute financial ratios. Some of these ratios are self-explanatory and some of them need a little bit explanation. We have something called return on equity. Return goes to net income. Equity goes to total stockholder equity. So if we divide this one by that one, we do get return on equity, which is net income divided by total stockholder equity, and I have it here. Then we go to return on assets. The denominator is clear, that is our total asset. What about numerator? Numerator is not net income, but more than that, because we have collected these assets. Some of them come from stockholder equity, some come from liabilities. Therefore, we shouldn't subtract interest from earnings. We should add it back. Add back interest that we have paid to this net income and then divide it by total assets. However, we cannot add total interest to net income because we have subtracted that interest from income and we have saved some taxes due to that expense. $141,000 has saved us. This much multiplied by our tax rate has reduced our tax by this much. Now, if I'm going to add it back to it, I should extract the tax. I first need to add to net income, interest, multiply 1 minus tax rate. That is which can be taken back. And that is how I have computed it here. We have got interest, have multiplied by 1 minus tax rate, and have added it to it. Now, this summation should be divided by total asset to compute return on equity. Return on financial leverage is the difference between return on equity and return on asset. And that is how good we have used the money that we have borrowed. Profit margin is simply defined again as earning before interest divided by total revenue. Now I should explain inventory turn, account payable turn, account receivable turn, and cash to cash cycle. Let me simplify the example as much as I can. First, suppose you spend $2,400 per year on your grocery. And suppose at each time you have $100 grocery in your refrigerator, in your condominium or so on. How many times $1 of grocery is replaced by another dollar? You spend $2,400. On average, you have 100. Therefore, your inventory is turned 24 times. $100 is there. You consume it and you purchase. You consume it and you purchase. Because you spent $2,400 and because on average there is $100 over there, each dollar of that $100 would be replaced by another dollar 24 times. That is what we call it inventory turn. Now suppose instead of grocery in the ref, this is inventory. And instead of purchasing grocery, this is cost of goods sold. Therefore, inventory turns or inventory turnover or inventory turn is defined as equal to cost of goods sold divided by average inventory which you have, and in this case it is 2400 divided by 100, and that is 24 times per year. So your inventory is turned 24 times over a year. How long it is there? Because it is replaced 24 times a year. Therefore, on average, it is there for 1/24 year. And 1/24 year, you can multiply it by 12 to get it in terms of month, which is half a month, 0.5 month. And then you can multiply it by number of weeks per month or number of days per month to get flow time of your operations material. Now, if you have paid cash for this inventory, and if you get cash when you sell your product, therefore cash to cash cycle in your system would be 1/24, which is equal to 0.5 month. And if amount is 30 days, that would be 15 days. That is your cash to cash cycle, and that is also the flow time of $1 or 1 unit of product throughout your system. Suppose you sell this product for $3,600. You spend $2,400 and you sell it for $3,600. If you immediately get the price, your cash to cash cycle is 15 days. But suppose on average you have $500 in accounts receivable. So you sell at rate of $3,600 per year, but on average you have $500 account receivable. Therefore, your account receivable turn is equal to 3,600 divided by 500, and that is equal to 7.2. How long does it take for you to get your account receivable? It is replaced 7.2 times. A year is 12 months divided by 7.2. That will be 1.67 months. Account receivable turn is 7.2, and time to get your money is 1.67. Therefore, now cash to cash cycle is 0.5 months through production and 1.67 months, and that would be 2.17 months. But when you buy raw material, you don't pay it immediately. Suppose it takes some time for you to pay it. Suppose your account payable $400. Therefore, account payable turn is equal to cost of goods sold divided by accounts payable. That is 2,400 divided by 400, and that is 6. 6 times is turn. Therefore, it is there for 1/6 year, and 1/6 year is 2 months. Therefore, cash to cash cycle is equal to 0.5, which was the time that the product spent in your manufacturing or distribution system, plus 1.67, which was the time that it takes to cash your money, minus 2, that is the time you have to pay what you owe to the suppliers. Therefore, cash to cash cycle in this example is 0.17 month. From the time that you spend $1 until the time that you get it as the sales price of your product, it takes 0.17 months. Don't forget, all these computations could have been done in the spirit of the Lidl's law. Throughput in your company is $2,400 per year. That was cost of goods sold. Inventory was 100. Therefore, throughput times flow time is equal to inventory, that is 2,400 times flow time is equal to 100, and therefore T is equal to 1 over 24 year or 0.5 months. Regarding account receivable, throughput is 3,600. Inventory was 500. Therefore, throughput times flow time is equal to inventory. That means 3,600 times flow time is equal to 500. And therefore, flow time is 500 divided by 3,600. And if you multiply by 12 to make it in terms of months, it is 1.67. The same goes for account payable. In account payable, your throughput is cost of goods sold because you purchase material at their cost, not at the value that you sell it. So that would be 2,400. Account payable was 400. Inventory equal to 400. And therefore, throughput, 2,400 times flow time is equal to inventory, and therefore equal to 2 months. It takes 0.5 months to pass the supply through your system, 1.67 months to get the sales, and it takes 2 months to pay what you owe to supplier, and therefore cash to cash cycle is 0.70. Now let's go up. Here we are, inventory turn is equal to cost of goods sold divided by inventory. Here we have cost of goods sold, and here we have inventory. If we divide by each other, that is inventory turn. Account payable turn is cost of goods sold again, divided by accounts payable. Account receivable turn, not cost of goods sold, but total revenue, divided by accounts receivable. All of them are well explained here, and over. And cash to cash cycle I have already explained. Sales, general and administration divided by revenue. Here is sales, general and administration. Here is the cost divided by revenue. Property, plant and equipment turn, that is total revenue divided by this. Everything is inside Excel sheet. You can go and click on them here or there, and I think everything is now self-explanatory. Thank you very much for attending this session.